We all know interest rates have skyrocketed over the past year and they continue to climb, leaving home buyers with historically high mortgage payments. So, what do you do if you have to buy in this market? We're going to talk about that today on Experience St. John's. Welcome back. If this is our first time together, I'm Gary Davis, Realtor with Coldwell Banker Vanguard Realty and creator of Experience St. John's. I keep hearing people say things like, interest rates aren't that bad. Back in the 80s, we had interest rates of 16, 17, 18%. And while that's not untrue, the comparison really isn't a valid one. Because, for instance, in 1982, the average home price in America was $69,300, well below $100,000, making that home's monthly payment affordable. The same really can't be said for today's market. For example, buyers buying a home in St. Johns County today for $500,000, which is just below our average sale price here in September of 2023, can expect a home mortgage payment of somewhere around $3,300, whereas a year ago, that same mortgage payment would have been around $2,300. And that $1,000 difference is just because of the increase in rates. And this increase in rates is simply putting homes out of reach for a lot of buyers. So that begs the question, if you have to buy a home in this market, what do you do? Well, there are a few options. The first and the most obvious option is to ask the sellers for a price reduction. This is a good option for most buyers with traditional loan qualifications, and it will allow the buyer to save money over the life of the loan. Another option is to ask the seller for a concession toward the buyer's closing costs. This is a great option for buyers who are struggling to come up with the cash needed to close, and it will allow them to save cash now. Another option is for the buyer to ask the seller for a concession toward points. This money is then used to buy down the interest rate of the loan. Every point purchase typically reduces the interest rate by 0.25% and costs roughly 1% of the loan amount. So, on a $500,000 home, 1 point would cost $5,000 and would reduce the interest rate by 0.25%. This option is great for buyers who aren't likely to refinance soon because maybe they don't think rates are going to come down anytime soon. It requires a little bit of money up front, but it's great in the long term because it allows the buyer to save money over the life of the loan. Buyers who are planning to refinance should not use this option. The final way buyers can combat the rate dilemma is by asking for a 2-1 buy-down. In a 2-1 buy-down, the buyer would pay a mortgage based on 2 percentage points less in interest for the first year and 1 percentage point less in interest for the second year. In the third year, it would return back to the normal rate. So, for example, if a buyer took out a mortgage based on a 7% interest rate, for the first year, their mortgage would be based on a 5% rate, and for the second year, it would be based on a 6% rate. The third year, it would return to the 7%. Now, you're probably wondering, well, what happens during those 2 years? Doesn't the mortgage company want their money? Of course they do, and that's where the seller comes in. So at closing, they calculate the total amount of money that the buyer is saving by this 2-1 buy down, and that is the amount of money that the seller contributes at closing. It is then held in escrow and distributed to the mortgage company each month in conjunction with the buyer's payment to submit an entire full payment to the mortgage company for those first 2 years. After that, it returns to the normal rate. Let me give you an example now with numbers because if you're like me, I'm visual, I need to see this. So for our example of a $500,000 home, at a rate of 7%, the total amount of seller contribution at closing would be $11,654 and would lower the buyer's payments by $642 per month for year 1 and $328 per month for year 2. At that point, all of that money, the $11,654, would be put into escrow and distributed at that rate for those 2 years in order to save the buyer money, but still make the mortgage company whole. This 2-1 buy-down option is a great option for buyers who are rate sensitive and who plan to refinance in the next couple of years. All things indicate that rates should come down in the next couple of years, and we all have our fingers crossed that they will. So if I had to buy a home right now, I would strongly consider this option. Now, obviously, this video is geared toward buyers who are buying homes, But sellers, you really should take heed of what I'm saying here as well, because in this market right now, September 2023, it's definitely not as easy to sell your home as it once was. And using some of these tactics in your marketing can definitely help entice a buyer to maybe choose your home over the competition. It's exactly what new construction is doing right now with all of their incentives, so it's wise to incentivize buyers to pick your house over maybe a house down the road that doesn't have these incentives offered. So there you have it, 4 ways to help facilitate the sale of a home in a market with high interest rates, whether you're the buyer or the seller. I hope you found this video to be helpful, and if you did, consider subscribing to my channel and click that little bell icon so that you're notified each time I publish a new video. And in the meantime, here's another video you might like. Thanks for watching, and I'll look forward to seeing you right back here next time on Experience St. John's.